What's going on, everyone, and welcome back to another episode of Friends of Mortgage Heroes. I'm Brian.
I'm Andy.
And today we have Old Harbor in the house, one of our closest insurance partners. Welcome, everybody.
Hey, thanks, guys, for having me. I'm Carlo Diaz. I'm one of the co-founders, co-owners of Old Harbor Insurance, and we are a home and auto insurance brokerage. We're headquartered out of Temecula, California. However, we insure pretty much the whole West Coast, from Texas up to Idaho. We have a second brick and mortar up in Idaho. And we love talking all things home insurance and mortgage industry.
Awesome. Well, let's go ahead and address the big elephant in the room. I mean, what's been happening with insurances this last year was just, oh my God, chaos. And who else then, to share with us what's really happening, what should be happening, and just share with us a little bit of what we can expect.
Yeah, I think by now, most Californians are starting to feel a little bit of the volatility in the insurance marketplace. And so what I mean by that is prices are going up considerably. We've had over 80 different insurance companies leave the state of California in the last year. 80, right, exactly. Yeah.
I didn't hear that number.
Yeah, super 80. Wild, yeah. And so that's creating just a ton of volatility with the remaining companies that are left. We're seeing a lot of clients being non-renewed. The companies that are still remaining are just extremely critical of the clients they're willing to insure, right? Whether it be an auto insurance or home insurance. So it's just absolute chaos.
And I feel like it's, a lot of people are getting hit with the surprise when they come and say, like, hey, I got to renew my policy. Wait a minute. How high did it go up?
Yeah, exactly. So, we're seeing home insurance policies, triple in cost year over year. So we're talking going from like an average $800 to $1,000 policy up to $2,500, $3,500 in premium.
Yeah. We've been saying the same thing, quoting people out. Oh, it's $80 a month. No, it's $250 a month now.
Yeah, I used to use like $65 as a quote, and now I'm like pushing $85 to like $100, which is a huge difference, and sometimes that affects the debt to income ratio.
Absolutely, it affects affordability, right? In combination with interest rates and just crazy times. Absolutely. So what's causing the problems, right? What's causing these companies to leave California? And so basically, it's a combination of inflation, and what I mean by that, these insurance companies are responsible for repairing houses, cars, right? For claims, right? And with inflation, the cost to repair building materials, contractor costs are going through the roof. Combination with just number of claims. So California is the most populated state in our nation, right? There's over 40 million people that live here, right? We've got great weather. We've got amazing amenities.
13% of our entire population is in California.
Exactly, right. And so many of the homes that were built in the 70s, 80s, 90s, even early 2000s, they're just naturally starting to fail. And so when you see homes fail because of wetter winters, right, we're having more water and stuff. Yeah. It's not like standard states where there's less population. We're seeing mass claims, right? Yeah. Thousands and thousands of claims. And so you've got the inflation, you've got the volume of claims, but kind of the catalyst, the biggest issue is regulation. And what I mean by that is with regular businesses, like for instance, restaurants, right? I love California burritos, right? And I remember, I love a Cali, right?
Yeah.
And I remember, you'd be able to go to a taco shop and grab a Cali for like $6, right? $8.
Oh, no. It's like $15.
It is $15.
Oh my God! Don't even tell me.
It's crazy. It's wild, right? And so obviously the taco shop owners are paying more for their ingredients, for their labor costs, for rent, their lease of their space, but they can offset
their insurance.
No, for real. But they can offset those costs to the consumer, and that's why we're paying more. Insurance companies can't do that. They're regulated. If an insurance company like State Farm, we'll pick on them throughout this presentation just because they're the largest insurance company in the United States, so they're kind of an easy reference. But if they wanted to increase costs because they're hemorrhaging because of number of claims, because of inflation, they can't. The Department of Insurance in Sacramento, they have to review and approve any type of rate increase.
Right.
So that process is lengthy. It can take up to 2, 3, 4 years sometimes. And so you can imagine this intersection between hyperinflation, right, and their inability to adjust prices, and it's absolutely sinking them.
You know, I remember we talked about this last year because we were having a conversation when some of these changed and when like the 4 major carriers started non-renewing people last year and then basically leaving California. And we had a conversation about how they're chasing inflation because so our understanding was that it's capped. So there's a certain amount of percentage rate increase per annum that you can make or per request you make. And the fastest that'll get approved is like 6 months, right? Okay. So for those of you who are hearing about this for the first time, you can make these rate adjustment requests for premiums every however often, but it might take, the fastest it'll take is 6 months to approve that. But even then it's capped. So if your expenses of materials, labor, and number of claims gone up like 20%, but you can only go up 6, you're chasing it constantly.
Yeah. What you're referencing is Prop 103. That was passed back in the 1960s, I believe. And basically that allows the Department of Insurance to regulate these insurance companies and their price increases. It's supposed to protect the consumer, but again, to your point, it really kind of limits.
But now it's removing the protection altogether because the insurance companies can't stay in the game to play.
Right, exactly. And so I think it's 6% is like the maximum that they can request each time to have that expedited, that 6-month time period, right, where rate is adjusted. And that is not enough.
You'd still have to do that 3 times consecutively, which is 18 months to get 18%.
And I've spoken with many insurance companies. We've had different, Zooms and stuff with, Nationwide Insurance, Mercury Insurance, and they have them backed up, like on back order, these increases.
Dang.
And so this is the thing, though. This is them trying to operate with these regulations in place. But what they really need is like a solid 30% increase or 40% increase, but that's not happening.
Hold on though. Then that actually just then sets and fixes the inflated price though, because that's not going to be returned back downstream if that changes, right? If we see labor costs go back down, I'm playing devil's advocate here, right? But if we don't see material costs go back down, labor costs go back down, that isn't going to just necessarily come back downstream to the consumer. Am I like being too hard?
Well, what I'm understanding is basically we have to get it adjusted to the cost of living. And right now, it's covering only what the cost of living was probably few years, a lot of years behind.
It doesn't sound like cost of living. It's not like cost of fixing.
Yeah.
It's for cost of fixing and the amount of fixing. So you have a volume problem on one hand and a cost problem, and they're both playing in the same on the same field.
Yeah, here's some other examples. So like when we're talking about sustainability for these insurance companies, and so like I had a client just a few weeks ago who wrapped up a home insurance claim, and it was a simple home insurance claim. They're insured by a company called Oregon Mutual. They have left California. They're one of the 80 companies that have left, and so they're non-renewing as they're coming up. And so simple leak under the sink, very common in a home. That policy, they were paying sub $1,000. This is like $950, $960 a year for their home insurance. Oregon Mutual paid out over $160,000. So how long do you think it's going to take them to recoup?
Wait.
160, and this is like.
Well, yeah, because I mean, if you're even, let's say per annum again, let's say you're making $1,000 a month in premium payments without even operating costs. Let's just say you're grossing receipts $1,000 in every year. Sorry, not month.
Yeah.
Even if you have 10 years, they've taken in 10, they're paying out 160.
Yeah, and so
but that creates a reinsurance problem though for the insurers of the insurers.
It's like a trickle down effect.
That is exactly another element that we were going to talk about too.
Oh my God!
Why
it gets worse?
Sorry, I'm not trying to get ahead here.
No.
This is insane.
It's a total bird's nest. And so, we're talking about inflation. We're talking about volume of claims. But there are elements in the state of California specifically that are creating additional burden. And so what I mean by that is other states other than California can bake in the reinsurance cost into the policy. California doesn't allow that. The Department of Insurance.
Oh, I didn't know that.
So
I
it's
thought
just
that was included.
Right, exactly.
I thought that was baked in. It's not.
No, it's not. Yeah.
Oh,
and so,
dang.
That's what I was thinking too.
Okay, because I didn't understand how the reinsurers were going to have such a problem. Or sorry, if the primary insurer, I didn't know why it would be such a problem for them because I thought that they were including the price of the reinsurance in their policy premiums.
Yeah, and we'll explain to the viewers what reinsurance is.
What?
But so how about this? So not only are these insurance companies in handcuffs going, we can't increase prices, right? Because we're hemorrhaging because of claims and inflation.
Yeah.
They still have to pay reinsurance, and what that is insurance companies, they don't carry all of the burden, all of the risk on their own. They offload that. They pay reinsurance companies. Larger companies
for your insurance, right?
Insurance for the insurance, exactly. And they have to pay a cost. And because of all of these elements, the increased claims, the inflation, the reinsurance companies are going, whoa, this is not a good bet for us anymore. So if you want us to take this, we're going to charge you triple, right?
Yeah.
But
and we're seeing it.
Again, the insurance companies can't bake that reinsurance cost into the consumer price. So tell me, how is that sustainable business?
It isn't.
No, it's not.
You can't.
And this is why we're seeing this mass exodus of insurance
So
companies.
so on their P&L, P&L, basically, they have a 3x expense that they can't go and charge the client for. Go back to your burrito example.
Yep.
That's
Yeah,
like,
they're eating it.
My carne asada is costing me 3 times more, and you're not allowed to charge the client for it.
But
that's insane.
Here's a crazy statistic that I just was reviewing. And so, again, State Farm, the country's largest insurance provider, they're carrying a $12.49 billion loss for the first 3 quarters of 2023. So just the first 3 quarters of 2023, that surpasses their entire annual cost for the 2022.
Oh,
What?
get the hell out of here.
So do you think the problem is improving or getting worse?
No, it's getting worse.
It's getting that. Those are crazy numbers, right?
I'm imagining more claims are coming up, more problems are happening, and these insurance are just bleeding. They're like, I'd rather pull the cord and just take a loss on what I have, and from there just go elsewhere. I mean, it just doesn't make sense to operate.
Absolutely.
Okay. So. Sorry,
Take a second.
I have like 100 questions, right?
Sure.
We're not gonna have time for 100, but I got like 100 questions. So we know where we're at. We got our finger on the pulse. What happened last year in 2023? But what does that look like for everyone watching this now? What does that look like for this year moving forward? We have a lot less insurance carriers available in California. The ones who are available are going to be facing the same type of, let's say, Excel spreadsheet profit and loss problems. How can I charge more, get enough premiums to actually do the service I'm supposed to be doing here in the state? What options are available to people? What should they be looking at? How can they navigate this? How can we help people navigate this on the mortgage side of things?
Yeah,
let's go down that path a little bit.
First, I'll kind of explain what the landscape is going to look like currently, and then in the future, and then we can talk about like tips to front run this volatility for consumers. So what we're seeing right now is a trend shifting from admitted insurance companies, and admitted insurance companies are companies that we've all heard of: Nationwide, State Farm, Farmers. And admitted insurance companies simply are regulated by the Department of Insurance. So they have to adhere to specific guidelines, carry specific financials. And then you've got what's called non-admitted insurance companies. These companies are not regulated by the Department of Insurance. And so these are companies like Lloyd's of London, in Scottsdale Insurance. And so historically, they were used as like for more challenging properties, like in Tahoe, high fire type stuff. They were more willing, more liberal to take on this risk. But
Astronauts going to space, Lloyd's of London,
yeah, exactly. But
Oh, they insured that?
they insure people for like really crazy stuff, like one-off things. It's crazy.
Michael Jackson's hands and all kinds of crazy stuff.
People's actors' body parts, stuff like that.
Yeah, exactly. And so the crazy thing is that they charge more, right? If they're willing to insure it, they're going to pay more. So again, historically, you would always want to acquire insurance in the standard market, right? Admitted market. And then if you couldn't, then you would go to non-admitted. And these are reputable companies too. A lot of these non-admitted companies are some of the admitted companies, just their non-admitted arm. So they're huge, very financially stable. And then you've got this third, if no one will insure you, marketplace, and that's the California Fair Plan that was built here in California. And so what we're seeing, this trend, is that for the last decades, as far as we've all remembered, you can easily get insurance, right?
Yeah,
We've never had a
piece of cake.
We've never had a problem getting, right? It was competitive. You had tons of options. Right now, everything we just discussed, is very difficult to have an admitted company insure you. And so we're seeing this emergence of a very comprehensive non-admitted marketplace. Lots of new companies rolling out. And as a broker, insurance broker, so you've got what's called a captive. That's like an Allstate, State Farm, and they don't broker. They only have that single option.
Right.
I am a broker, and so we represent over 50 different insurance companies. So we're always onboarding new options. We've got to stay relevant for our clients and offer these options. So
It sounds like what we see in the mortgage industry. It comes with creative options, right?
I was just going to say that when you said admitted a company's insurance, that's basically like, your regular Fannie Mae, Freddie Mac. And then there's non-QM when people can't go the traditional route. But then we don't have a third option.
Well, yeah, hard money, I guess.
But I mean, that still goes into like non-qualified. But yeah, I mean, we're facing the exact same problems on our end. And as far as like the broker side, it's like broker versus direct. Yep. On the broker side, we have a lot more feasibility and options to be able to, help our client in a better way.
In quick side note, a lot of clients will ask me, how do you get paid as a broker, right? Is there a broker fee? Do you guys charge? We don't charge any additional cost. How insurance agents get paid. And I love sharing this with everybody, the transparency, because you get understand value and you can assess your insurance agent. Is we get paid, and on average, it's 10% of the insurance policy cost, right? So if the average insurance policy was $1,000, $100. So that's not going to pay my mortgage.
Yeah.
So the value for me as an agent is that residual. Every time that policy renews, we get that small $100 commission again.
Yeah.
And the reason why I like sharing that, especially with our clients, is the only way it can get you to renew is if we provide solid options, competitive rates, quality service if you need claims help, right? And so if you're not getting any of that with your current agent, maybe it's time to look elsewhere.
And it becomes a game of attrition and retention.
Yep.
I mean, because you have net positives, net negatives, right? So you might
yeah.
have some people that drop policies, or maybe you have a set of policies with a carrier that they've now left California. You have to like remove them to some other provider. If you don't, you miss that. So you might have you might have 30 policies that drop this year, but then you got to replace those 30 policies just to be at the brake line, water line that you were.
Yeah,
exactly.
We are. I tell people often. I mean, both in the mortgage and insurance space is so volatile. It's so difficult right now, and it's the hardest we've ever worked. But we're writing so many insurance policies, so it's kind of like a double-edged. It's a double-edged sword, and that's because our competitors don't have options our competitors are now our partners in sending referrals. But anyways, back to the landscape.
Well, but just real quick pit stop on that. We've been working with the analogy since 2023 of Hunger Hippos.
Yeah.
There's a certain number of marbles on the board. You got to get as many of them as you can. Now with less players on the field, there's more business going to those that are left. It's just the way it is.
100%. I mean, we've been seeing it all last year up until 2024, and now we're here.
Yeah.
Yeah, good stuff. So again, the landscape is transitioned from traditional insurance marketplace to a non-admitted marketplace. So this is something that as consumers, as realtors, as mortgage professionals, we need to kind of understand that concept. It's going to cost more. It's not going to, options are going to be limited. We are in the eye of the storm. This is what I'm telling my clients. Like, hey, I do have an optimistic outlook, and there are things changing in the background in terms of legislature through the Department of Insurance that will create a more stabilized landscape in the insurance space. But that's
when
not for a while.
are those coming down I was going to say, I think I read that, but I think that's not coming until 25, right? Or 26.
Yeah, at the minimum. And so one example of that is Gavin Newsom issued a statement of emergency. Is that what they're called within the state? State of emergency.
Declaration of emergency, whatever it was.
And basically
I declare an emergency.
And
I say this is important.
And that gives that gives regulators special powers to adjust legislation. Anyways, all of that to say that the Department of Insurance came out 2 hours after he issued that. This was in August. And they said, hey, these are the items that we're going to change. And so what they're talking about, what he had referenced, and this is what the insurance industry, the mortgage industry, the new home builder industries, they were all lobbying all summer long in Sacramento going, hey, the home insurance space is messed up and we need help. And so everything that the insurance commissioner came out with after that declaration of emergency was a lot of the points that the industries were echoing all summer long. So it's kind of like better late than never, but I'm just staying positive that at least they're sounds like they're on the same page now, but some of those items are baking in the reinsurance costs. And also too, another element that we didn't talk about was CAT rating, catastrophic rating. So like in Florida, and
talk about that. Unpack that a little bit.
And so like in California, their rates are pretty flat, and they're not allowed to. An insurance company is not allowed to charge more for homes because of distance or proximity to a catastrophic event like tidal waves or like wildfire. And so that obviously is hamstringing their ability to be profitable too, right? If they can't charge appropriate pricing for the appropriate risk, no one wants to play that game, right?
Yeah.
And so, again, these are points that they're talking about. Gavin Newsom gave the insurance commissioner, Laura is his last name, until December of 2024 to have these implemented. So, again, to your point, Andy, that we're not going to see the benefit of those. If they're just being implemented, until December of 2024, we're not going to see the benefits for years to come.
Wow.
But hey, I'm at least optimistic that we've got, some movement, and who knows, other things can happen, maybe the economy changes.
But on this side of the court, we're optimistic as well. I mean, we see the Fed going up, speaking about what their outlook of what's going to be happening, and we can only take the best guess of what we think they're doing and be hopeful, have that faith that, things are going to work themselves out because they haven't really been working them. But at the same time, all we could do is be hopeful because we see what's happening. We see the data, and all we know is that it's a harsh reality of what we're facing.
Yeah, I'm a half glass full guy for sure. And California is always going to be a leading state, right?
Definitely.
It's always going to be desirable regardless of cost of living, and so there's always going to be solutions. There's always going to be something. So we just kind of, again, got to get through that eye of the storm, and I think we're going to see some loosening of options.
So tell me what you think as far as okay, so we're talking about them being less options now than before. You have more business than before, though, at the same time, because people have to go somewhere. What will it incent providers to come back to California?
That's a good question. So rate, first of all, right, they've got the Department of Insurance has to approve rate increases. Also, too, we had talked about the reinsurance rating. And again, they're talking about allowing these insurance companies to build that reinsurance cost into the consumer pricing, what they're paying. The cat loss stuff, too. So I think as we start to see that be implemented, we will see insurance companies come back. And I've already seen it. We represent a handful of admitted companies that are still operating in a very healthy capacity.
Yeah.
So an example would be Mercury Insurance. Mercury Insurance is a killer company. They're headquartered out of Orange County, and they have had multiple rate increases approved through the Department of Insurance. And so what they're experiencing, though, as you can imagine, with this vacuum of insurance options, is they're being absolutely inundated.
They're being
right?
bombarded.
Yeah, same thing.
Yeah. So what we're going to see, again, kind of this eye of the storm analogy, is that these admitted companies, these premium insurance options that are left, they're going to make us jump through tremendous hoops. And so, if you want to get car insurance, they're going to want photos of registrations. They're going to want to know when you purchased the car. They're going to want, I had one company ask for a copy of the marriage certificate, for husband and wife. And
I haven't heard that.
That's new. I've never heard that.
Yeah. And so think about it. If you were the only mortgage company operating in California, period, right? Similar to Mercury, you'd be inundated, right? With borrowers, right? Even in a difficult market, you would be inundated, right? So you're going, whoa, I have all these people because we've got the best mortgage rates that are wanting to work with me.
Yeah.
So you're going to have to regulate that. You're going to say, okay, we're only going to work with clients that have 800 or better FICA. Now we're only going to work with borrowers who are borrowing $1 million plus. And then you're going to add all of these wild layers on top. And that's what we're experiencing, unfortunately, with the remaining companies.
So what happens to the ones that can't get insured? They go through the California Fair Plan, and if they can't afford that?
Right. Yeah. And so the wild thing is, we'll talk about the California Fair Plan, is that the California Fair Plan was historically only created for a last resort if no one else will insure you.
Yeah,
Like it was a
safety. It was a safety net solution, was it not?
Yeah.
But it was funded by premiums from the agencies that were here in California, correct?
So it's all put
That's
in
where
the
all the
bucket.
money comes from.
Yeah, exactly. And so basically, the California Fair Plan started in the 1960s as an option to offset the Watts riots. Insurance companies didn't want to insure in difficult areas.
I
right?
did not know that part. Okay.
Yeah, absolutely. And so it's fire-only coverage, so it's not like a full comprehensive policy. And which is funny because there's a lawsuit that is starting next week between the Department of Insurance in California and the California Fair Plan.
Oh, wow.
Because the California Fair Plan, the Department of Insurance is trying to require Fair Plan to provide regular encompassing HO3 coverage
Who's
instead
gonna
of
pay
just
for that?
DP1. Yeah,
Who's going to pay for that?
yeah, it's a scary concept, but we could talk about it.
Yeah.
Again, I'm optimistic. I think it's
Same.
going to get better. Yeah. So, anyways, that California Fair Plan, again, it was meant as a last resort if no one is willing to insure you. But what we're seeing in this wild marketplace is that there are options, non-admitted options that we discuss, and it becomes an issue of uninsurable versus unaffordable, right? Because the consumer's going, I can't pay, $4,000 for insurance or $3,000 for insurance. And so they're flooding the California Fair Plan because it's maybe half that cost, whereas the Fair Plan wasn't designed to be competitive.
Yeah.
It wasn't designed to be a go-to option. It was literally a last resort. And so I was telling Brian before the show that right now in California, the California Fair Plan is the third largest insurance company in the state. It's so crazy.
Wait, what?
By default.
Yeah, super wild.
Wait, okay, hold on though. Give me some context to that. And it's okay if you don't know, but like were they 5 already, or were they like down here in the 40th ranking and now they're number 3?
Yeah, they were like down at the end.
Wow.
It was literally a last resort. And so I met with the president, her name is Victoria, of the California Fair Plan this Tuesday downtown San Diego. They had a meeting with brokers, and she was saying that they're taking 1,000 applications a day. 1,000 applications
What?
a day. Yeah. And so, so crazy.
That's a ton.
Yeah,
Whoa.
That's a lot. Okay, just give me context on that. What's a heavy day for you guys on taking applications?
It's hard to contrast an actual insurance company, right?
Yeah,
I know. I'm
of
just
course,
saying,
of
like,
course.
give me a number. Like, is 20 a long day for you guys?
That's a busy day for us. It's 20.
Dang.
So yeah.
Okay. I know.
And you guys stay busy. I know. So it's like,
yeah, I was like, understand. I know there's scales of volume.
Jesus.
You guys are not even by no
context.
stretch of the imagination are you a small company. First of all, so let's let everybody understand that. So 20 is crazy compared to this 1,000 you're talking about.
Yeah, I think we did we insured over 200 new home escrows. This is purchases, not renewals. This is just new purchases.
Nice.
But again, we write in Tennessee.
True.
Texas,
Of course.
But 1,000 per day in California.
Yeah.
Okay. So that would march you up the ladder really quick to number 3. Fair plan. Number 3.
And in a month you're
so who's number 1
it.
and 2 then still? Because State
Farm
left.
and I don't recall who number 2.
But I thought they left.
But that's because
they just left
the remaining
home.
policies, right?
Yeah, right.
Because of the remaining policies.
These are companies that are insuring homes in the state of California.
Understood.
They're not writing any new business.
They're not writing new business.
basically.
I got
Yeah.
it. But so that's eventually going to tip then, because as they start letting non-renewals month over month fall off,
They're gonna have to go somewhere.
they're going to start.
Fair plan.
Yeah. So they legally they can't non-renew you without reason. So we're starting to see like letters like, hey, trim these trees. And I've had clients, it's part of their landscape. And example, I had a client of mine, long-term client. He's an attorney in Poway, and he got a letter from his insurance company that we represent him with, and he goes, they want me to take out all of my landscaping in the back of my house, and this is like a part of his pool and everything. And it wasn't so much, and I'm like, whoa. I know, I'm like, hey,
wait, what?
They're like, redo your house.
Well, the thing is, I'm like, hey, Justin, it's not about you, right? Don't take it personal.
Yeah,
we got to read between the lines, and we kind of unpacked all of these, all of the details. Yeah. And so they're just, they know statistically if you're in a rural, quote unquote rural, Poway is a little bit more rural than,
Yeah, it's in there.
Yeah, and so they're looking for opportunities to maybe legally non-renew policies. And again,
kind of like,
but where's the line? Where's the line of the personal preference? If you're telling some dude, hey, you gotta change this and change this about your backyard. You're like, hey, I spent $10,000, $20,000 on these plants and trees. Now I gotta move my avocado trees because you don't like that it's harvesting fruit. Like, that seems kind of like a boundary of like, where are we now enforcing on people's personal agency?
The thing about that too is that we talked about it earlier, is communication. It all comes down to communication. And if you understand why these companies are being hypercritical, right? And because they're losing, $12 billion in the first 3 quarters of 2022, right?
Well, yeah. I mean, I understand the risk volume is spiking because everyone's left is going to be assuming more risk. They might be getting more policies, but they're assuming more risk. They're just the next State Farm to have this problem where by 3 quarters of the year, you're in greater loss than you were the year prior for the whole year.
Yeah. Well, hey, let's talk about happier thoughts then.
I'm just mad this dude's got to cut his avocado tree.
I know, right? He probably just started getting avocados too, huh? That's why he's probably even more mad.
In that scenario, what I referenced about communication is I communicated all of these elements, and so that he wouldn't take it personal. I told him we have alternative options. Alternative options are going to be 3-4 times the cost of this particular option. I think this is a valuable option. So if you don't want to take the landscaping out, let's look at transitioning to one of these alternative options. But if you feel like it's worth securing that option, play the game. Yeah.
So if the insurance commission comes to you, Carlo, and they say, all right, Carlo, we need you to lead the way, what's the first thing you're tackling down in the insurance space?
Like if I was an actual insurer, or are you talking about broker communicating to my clients?
If they ask you to, advice on what needs to be done and regulated and fixed so that insurances can, be more, accessible and more and better for people.
Honestly, I feel like it's they need to allow insurance companies to adjust pricing, and it's hard as a consumer to understand that, right? Because we're going, I don't want my rates to go up, but I think the adverse will happen if we allow these insurance companies to adjust rates so that they are profitable again. And they come back in. Competition suppresses pricing, right? When you have more, when you have more
Capitalism.
options. So typically, historically, when these companies ask for rate, right, from the insurance commissioner, that doesn't mean that they're gonna, and it gets approved. That doesn't mean they're gonna full throttle, right, on all of their allotted rate. Typically, they'll put it somewhere in the middle. They've got to stay competitive, right?
It's resetting a boundary line. Yeah,
exactly.
Price,
because if they were to charge the most, no one's going to buy from them.
They'd be out of market. They're pricing themselves out. Yeah,
exactly. So if we allow these insurance companies to adjust pricing to get back into a healthy capacity, healthy space where they're profitable, and they come back to California, I think we'll see prices actually suppress. Exactly. I think we'll see, harder to insure homes are going to, be more expensive, as they should be, right?
Yeah.
It's larger risk, but I think for the majority of us consumers, we'll see those prices kind of settle. I don't think we'll ever see 800, 900 average premiums anymore, but I do think we need to just be open to the fact that prices are going up, right? I used to pay up 99 cents for gas when I was in high school, right? That we're not doing that anymore, and so
Everything's adjusting.
Yeah, same goes with home insurance. So
Carlo, thank you so much for taking the time to come down, speaking to us about insurance. Literally teaching us what's happening and sharing everything that you know. Before we head out, where can people find you online and on social spaces?
Yeah, you can find us online. We're oldharbor.com. If you go on Instagram, we're robust on Instagram, and we're just Old Harbor Insurance. Google us. We've got over 500 five-star Google reviews from home buyers. And yeah, absolutely.
Thank you so much.
So I have a question for you real quick before we go.
Sure.
What are tips you might give someone who's watching this episode? Here's what you should do this year. We know just coming out of the holiday season, what would you tell people looking forward in 2024 to be mindful of, be aware of, and make maybe some discerning choices about?
Perfect. So the first thing would be, if you own a home and you have home insurance, make sure the mortgagee clause is up to date on that policy. And what I mean by that, if you have a mortgage with, UWM or whoever the company is, on that insurance policy, when it renews, they send the invoice to the mortgage company as part of the impound account. The mortgage company pays the property taxes, the home insurance, they just divide it equally into the monthly mortgage payment. And what we're seeing in this volatile market is that it's very, very common that mortgages are sold to new servicing companies, right? And so what we're seeing in this market is they'll send an invoice to the mortgage company. Maybe it's the loan has been sold or there's a new servicer, so the home insurance doesn't get paid and it cancels. And we can't issue, they're not going to rewrite that policy because of the climate right now.
That's a good phone call from our clients.
Yeah. So
it's a great phone call.
That's a great phone call from my clients. I just wrote that down.
It's so important. Wow. It's so important.
Wow.
So that's the first tip, is to just make note of it, to make sure that your home insurance is accurate and up to date with a current servicing company. Second tip is to wrap your head around being more responsible when using your insurance, whether it's your car insurance or your home insurance. And what I mean by that is, a lot of times I feel like over the last few decades, people use their insurance liberally. And obviously this is what we pay for, but if you file claims, your rates go up. And typically if you have 2 or more claims filed against a home within a 3-year window period, most insurance companies will non-renew you. So you really want to be smart and really only file claims for catastrophic losses, right? You've got to be a proactive homeowner, take responsibility. We are recommending a lot of our clients even increase their home insurance deductible to $5,000. And so anything under $5,000, pay out of pocket and really leverage, use that policy for catastrophic losses. So 100%. That's going to be a benefit in 2 ways. First, it's going to suppress the cost. The higher the deductible, the lower the cost of the insurance. And second is positioning, right? If you are showing the insurance company that you're willing to be a responsible homeowner, not file small frivolous claims, chances are you're not going to be non-renewed, or they're going to stay off your back. Third tip is to connect with a home insurance broker like Old Harbor Insurance. Hey. And because we are constantly bringing on new options, I had a client that was referred from a San Diego Gas and Electric employee. He's one of our current clients, and his coworker is buying his first home in Ramona. And he called me and he's like, hey, we're in the big truck right now, and my coworker's buying a house, and he's running into problems with ratios because this insurance is so expensive. Yep. So it's the California Fair Plan. Again, it's fire only, so you need a second policy to cover everything else: water, liability, theft. And so that combination, we can do a whole nother episode on Fair Plan, boys. And so that combination was really increasing his ratios. So his friend referred him to us, Old Harbor Insurance, and the agent who was trying to sell that Fair Plan was a broker too. And he was probably a good agent. But again, we pride ourselves in being broad and having the most options for our clients. We were able to place a policy for him that day. I told him, no promises. Let me get all your information. We quoted it. It was a non-admitted insurance company. It was $1,000 less than that Fair Plan option. And we had issues the same day. And he's one of the 500 Google reviews in the last 10. So again, last tip is connect with an agency that's comprehensive. And so we'd love to help. Oldharbor.com. You can Google us, check us out on the internet, and
very active on social media.
Yeah.
Thank you so much. I really appreciate it, Carlo. And for everybody listening at home, stay tuned for this episode, and we got a lot more to come.